The global financial crisis of 2008, often called the Great Recession, was one of the most severe economic downturns in recent history. It began in the United States and quickly spread across the world, leading to widespread economic hardship, high unemployment, and significant financial instability. The crisis was triggered by a combination of factors, primarily rooted in the financial sector. In the early 2000s, the U.S. housing market experienced a dramatic rise in property values. This was driven by easy credit, speculative investments, and the widespread belief that housing prices would continue to increase. Financial institutions began issuing subprime mortgages, loans to borrowers with poor credit histories, who were often unable to repay. These risky mortgages were bundled into mortgage-backed securities, MBS, and sold to investors worldwide. As housing prices began to decline, many homeowners found themselves owing more on their mortgages than their homes were worth. This led to a surge in foreclosures, which caused the value of MBS to collapse. Deregulation in the financial industry allowed banks to take on excessive risks. Complex financial products, such as collateralized debt obligations, CDOs, and credit default swaps, CDS, spread risk throughout the global financial system, making it difficult to assess the true level of exposure. Financial institutions became heavily leveraged, borrowing large amounts of money to invest in risky assets. When the housing market crashed, these institutions faced massive losses, leading to a wave of bankruptcies and failures. The crisis came to a head in September 2008, when Lehman Brothers, one of the largest investment banks in the U.S., declared bankruptcy. This event sent shockwaves through the global financial system, leading to a severe liquidity crunch. Credit markets froze, stock markets plunged, and governments were forced to intervene to prevent a total collapse of the financial system. The effects of the crisis were felt worldwide. Many countries entered deep recessions, with some, like Greece and Spain, facing prolonged economic downturns. Unemployment rates soared, millions of people lost their homes, and entire industries were disrupted. The global economy contracted, and recovery took years. Governments and central banks responded with unprecedented measures to stabilize the financial system. In the U.S., the Federal Reserve cut interest rates and introduced quantitative easing to inject liquidity into the economy. The U.S. government also passed the Troubled Asset Relief Program, TARP, which provided billions of dollars to bail out banks and other financial institutions. Internationally, the G20 countries coordinated efforts to stimulate economic growth and reform financial regulations. The 2008 financial crisis underscored the dangers of excessive risk-taking and the interconnectedness of the global financial system.